Jacqueline, thank you for coming in today to talk about internal models in the capital framework. This is clearly an extremely important issue. Can you just explain what's going on?
Well, it's important that the capital framework, so regulatory capital, is as risk sensitive as possible. And that means that capital should be proportionate to the levels of risk that a bank faces. And it's really by using internal models or internal measurements of risks that banks can get the most accurate measurement of their risk. They know their business better than anybody else. That's what gives you the most accurate measurement of risk. And therefore, if you align capital measurements to the bank's internal measurement of risk, you'll get the most risk-sensitive capital framework.
But I think you're suggesting that this may not be the only way of looking at this issue.
There is a debate going on for the moment as to whether or not firms should be allowed to use internal models for regulatory purposes. The alternative being that supervisors would kind of impose some kind of capital measure to some extent, a little bit regardless of the underlying risks of a bank.
And the purpose of having a kind of variable risk-based approach is what? So that you said it makes banks' capital more sensitive, but does that kind of liberate capital when it's needed?
Well,
I mean, what's it all about?
Precisely. I mean, if a bank is engaged in more risky activities, you'd want it to hold more capital to protect itself against those risky activities. If it's engaged in safer activities, there's less of a need to hold capital or high levels of capital. So if you're requiring a bank to hold one level of capital regardless of the risks of its activities, you're actually encouraging a bank to engage in riskier activities that would bring it higher returns, because a bank is inevitably assessed on its return on regulatory capital.
But it's also with withdrawing or withholding capital from the real economy.
Absolutely, absolutely. It's less of an incentive for a bank to invest or lend to low-risk clients or engage in low-risk activities.
But some regulators are concerned about the potential variability in the outcome. And how do we reassure on that point?
That's right. So some regulators are concerned that there's too much variability in the outcomes between different banks' approaches to models. But actually studies that have been undertaken both by the Basel Committee and the EBA show that 75% of the difference in our modeled capital outcomes are actually due precisely to underlying differences in risk. So the bank's portfolios, their risk management approaches, etc. So that's precisely what you want to see. It's the remaining 25% that they're worried about, in fact.
So explain, how does this 25% come about, and what is the concern there?
Well, they're not quite sure, or there is a concern that that 25% could be down to firms somehow manipulating their models and not representing real risk levels. But actually, these studies and work that industry is doing for the moment, these things show that that 25% is due to a lot of different factors that have nothing to do with banks manipulating their models. For example, there are different implementations of the capital framework which lead to different outcomes. Supervisors have different approaches in what they tolerate or what they allow in their modeling. And actually the regulation and the framework itself allows banks to sometimes make choices or doesn't specify technical definitional issues in some instances. So banks have been making choices. They might not all have been making the same decisions, but it doesn't mean that they're purposely trying to manipulate their models.
And one final question, Jacqueline. How does the international work that's been carried out by the Basel Committee dovetail with the EBA's work in Europe?
Well, I'm not quite sure that they do for the moment. What the EBA is doing is spending a lot of resource together with the banks, a lot of time on making sure that the space and the leeway that's in the regulation for the moment is reduced and is made as precise as possible. On the other hand, the Basel Committee seems to have jumped the gun a little bit and is not waiting for that program to really take effect in reducing the 25% that we were talking about earlier on. We're expecting that in March 2016, the Basel Committee is going to come out with proposals that will effectively limit banks' internal modeling And on top of that, they're also introducing capital floors that will be based on standardized or regulatory measures of regulatory capital. So in combination, that's basically going to reduce the risk sensitivity of the capital framework. And it's something that we're really concerned about in terms of banks being able to appropriately allocate capital to the real economy.
Thank you very much indeed, Jacqueline.
Thanks, David.